welcome and retro's greeting to you all who are now in front of myself. And today I'm going to take a session on accounting. And before launching my presentation, I would like to pronounce myself at first. And here I am Muhammad Mohammad Hussain, lecturer, Department of Accounting, Government Hussain Sohaib Sorority College, Magura. And today I am going to take a session on accounting. And today's topic is journal, and it is discussed on chapter 2nd. Dear participants, at the end of the session, we will understand about the concept of journal and the rules of debit credit and the system of recording the journal entries. And number 3, we will understand the respective transactions that will be recorded in the books of journal. Dear learners, you are observing some pictures of transactions. And transaction means at least two parties involvement. It must be measured by common monetary terms, either taka, dollar or pound sterling or any other currency. And number 3, it must be changed the financial position of both parties. So, it is time to understand the system of accounts for recording the transaction. So, the system of accounts means input, process, output. Every system has 3 parts. Number 1, input, process and output. Now the question, in what process the accounting will be adjusted in particular format? That means in what way the transaction will be transmitted. So in this case, input indicates to identify the transaction, and process indicates to record the journal entries posted to the ledger and to prepare the trial balance for rectifying the accuracy of the balances of transactions by maintaining debit and credit balances of the respective transactions that happens to come from ledger. And at the end of the session, that means from this process, we will get output. And in the language of accounting, its name is final account. So to identify the transaction, to record the journal entries posted to the ledger, and to prepare a trial balance. And even after that, the output is the final account. And final account indicates income statement, owner's equity statement, balance sheet, cash flow statement, and the principals and the note of various events. So these are the combination. This is the combination, and its final shape is final account. So 1, 2, 3, 4, 5 combination of these 5 points indicates the final account. Dear learners, and who are now in front of myself, and now I will go to the respective topic of today. Today's topic is journal, books of journal, and its name is primary books of account, because every financial transaction will be recorded primarily in the books of journal. This is why journal is called the primary books of accounts. So the definition of journal, that means by explaining the various transactions according to the date, according to their happening date, we have to write down in a book, and this book is name is the books of journal. That means by explaining the happening transactions according to their date, we have to write down in a book, and its name is the books of journal. So, the general format of a journal in front of you. At first, you have to write the name of the organization. Even after that, general journal. Then 5 column. How much column? 5. Number 1, date, names of account and explanation, ledger page, debit amount taka and credit amount taka. 1, 2, 3, 4, 5. This is the general format. This is the format of the books of journal. Okay. Dear friends, if we categorize or subdivided the journal entries, it will be in 2. Number 1, simple journal entries. Number 2, multiple journal entries. In case of simple journal entries, only 2 sides of account will be highlighted. Only 2 accounts will be included. And in case of multiple journal entries, within it, more than two accounts will be included. Okay. So, there are some steps are required to prepare a journal entries. Am I right? And in this case, the answer is 2. 2 steps is required. How much step is required? 2 steps is required. Number 1, you have to determine 2 sides of account. And number 2, you must need to determine debit and credit amount. Debit and credit amount of the accounts, of the respective accounts. Okay. We know very well there are 5 types of transactions usually happen in front of us. Not usually, happen in front of us. And these types of accounts name is respectively assets accounts. Example in this case, say for example, computer is an asset. Liabilities accounts, liability. And here the accounts payable or creditors is an example. Owner's equity accounts, it is a best example of capital. Revenue or income accounts, here the sales revenue is an example. And expenses accounts, here the best example is wages accounts. So assets, liabilities, owner's equity, income or revenue, and expenses. These 5 types of accounts are seen in front of us while dealing various transactions. Okay. So we know very well these items, that means the source of accounting, the originality of accounting has come from the country Italy, right? Italy, from Italy. And journal, the word journal, from here jar, the word jar has come from the word day. Jar means day. Okay. Luca Pacioli is the father of accounting, and his duration was 1445 to 1517. He is very known to us. He is the father of accounting. Okay, again we would like to repeat the definition of a journal by explaining debit and credit of happening transactions, we have to write down according to the sequence of date, and we have to write down this transaction in a book, and this book is name is the books of journal, that means journal. So it is mentionable that only after happening the transaction you have to write down according to the date by explaining debit and credit, and this is the first book for recording any transaction. This is why it is called primary books of accounts. Okay, so it is time to recall again for recording the transactions the debit credit rules. Only 1 minute is required to recall the system. We know very well owners' equity, liabilities and income. Here in expenses and assets. From assets we have extracted shop. From expenses we have extracted bought. That means shop. If shop increase, then it will be debit. If shop decrease, then it will be credit. Okay. So owner's equity, liabilities and income. From income we have extracted R. From liabilities we have extracted the. From owner's equity we have extracted more. That means Adam. So if Adam increase, then it will be credit. If Adam decrease, it will be debit. If Adam increase, it will be credit. If Adam decrease, it will be debit. Okay. That means Adam is alter of shop, or shop is alter of Adam. Again, just we would like to refine in front of you. If assets increase, then it will be debit. If assets decrease, it will be credit. If expenses increase, it will be debit. If decrease, it will be credit. In case of increasing income, it will be debit. In case of decreasing income, it will be debit. In case of increasing income, it will be credit. In case of liabilities, in case of increasing liabilities, it will be credit. In case of decreasing liability, it will be debit. In case of increasing owner's equity, it will be credit. In case of decreasing owner's equity, it will be debit. That means shop is alter of Adam. Just for better understanding, I have to submit again in this format so that you may understand very clearly. So I hope so it is very easy for you to understand at the same time. Dear learners and the participants who are now in front of myself, look very clearly. Every transaction must be two sides. That means at least two parties involvement is required. In this case, who will receives the benefit? He will be debit. Who gives the benefit? Who receives the benefit will be debit. Who gives the benefit will be credit. And every debit amount will be equal to its credit amount. Every debit amount will be equal to its credit amount. Okay. Let's go to the next slide for recording some transaction as an example. And I hope so it will be so easy, understandable, and you can put to your examination what types of questions are usually given to the question paper. So this is a question to you. Mohabbat Traders has some transactions on 2020 March May. On May 2020 Mohabbat Traders has done some transactions. These are given below. And these transactions are respectively from May 1st, then 2, 4, 6, 8, 10, 12, 15, 17, 19, 21st, 22, 25, 27, 29 and 30. That means 16 transactions are in front of you. Now we will solve this transaction and put in the books of journal entries. Okay, books of journal. So the first transactions on May 1st, Mohammad started his business by cash 120,000, product 50,000 and loan 90,000. So what will be the journal entries for cash and product? Cash debit, purchase debit, and capital and capital credit. That means 120 and 50 equal to 170. Okay. It is mentionable that RIN, that means loan, it will be separated from the capital. This is why we have to write down cash debit, cash account debit, and loan account credit 90,000. Okay, cash 90,000, here cash 120,000, 90,000, 120 plus 90, that means 2,10,000. In combination, in combinedly it will be 2,10,000. So these two journal entries we may write down in the format of books of journal in this way. Mohammad Traders General Journal, date May 1st 2019, 20, just I have replaced here 19. Okay. Cash account debit 2,10,000, purchase debit 50,000, capital 170, and loan account credit 90,000. Okay, cash debit, purchase debit, capital credit, and loan credit. Okay, now second, in 2019 May 2, purchase product 60,000. It is mentionable that purchase product, it is an expenses. We know very well expenses. If expenses increase, it will be debit. If cash amount has gone out from your business, cash is an asset. Am I right? Okay, however, 2019 May 2, purchase is an expenses, so if any expenses increase, it will be debit 60,000. Cash has gone from your business. Cash is an asset. If any assets gone out from your business, it will be credit. Okay. And it is mentionable that if here the purchase is not mentioned in cash, either in cash or on credit or discount. If it is not mentioned on credit or on discount, you will think that this transaction has been made in cash. Okay. May 4, our account has opened by Taka 50,000 to Rupali Bank. Am I right? So Rupali Bank is a personal account. Rupali Bank, Rohim, Korim, Rupali Bank, Insurance, etc. are the personal account. If any person receives the benefit, it will be debit. If any person gives the benefit, it will be credit. However, in this case, Rupali Bank is an organization or a person. He receives the benefit. That means Rupali Bank will be debit, and assets means cash. Assets has decreased or gone out from the business. In this case, cash will be credit 50,000. Rupali Bank debit, cash credit. Because account has opened by cash amount. Even after that, May 6, sold product by cash, certainly by cash. Sold product by 90,000. So what will be the debit? As for selling any product, cash has come to the business. This is why assets has increased. So cash will be debit and sold will be credit. Okay, cash debit, sold credit. And sold means revenue has increased. We know very well if revenue increase, then it will be credit. May 8, purchase product and provided a check to MIM. Provided a check to MIM. We know very well check means bank while providing any person. Okay, in place of cash we have to provide check. So it is also a asset. So in this case, purchase means expenses. Expenses increased, so purchase will be debit, and assets means cash. Cash means cash we have to provide through bank, that means by check. This is why assets has decreased. This is why bank will be credit. Purchase debit, bank credit. As we have to provide check to Mr. Mim for purchasing product. Bad debts allows for doubtful accounts. Allows for doubtful accounts, that means it is a fund which is made on debtors, that means on accounts receivable. So what will be the entry? The entry will be allows for bad debts account debit. Bad debts account debit, it is an expenses, and allowance for doubtful accounts will be credit. Okay, bad debts account debit and allowance for doubtful accounts will be credit. Now next, May 12, what will be the entry? Expenses, that means wages has been provided in cash. So expenses has increased, expenses will be debit, and cash has gone from the business, cash will be credit. Okay. For advertisement, some expenses has been made, taka 5,000. So expenses has increased. Expenses means here advertisement expenses debit and cash has gone, so cash will be credit. That means sales return. As sales credit, so sales return will be debit. Am I right? Sales return will be debit, and sales, the relation with the debtors, sales is interacted. Am I right? So sales return will be debit and accounts receivable will be credit. Okay. 15%. We purchased a product 30,000 and on it we get 15% discount. So as while taking the product, this amount has been set aside, so it will be not be considered in case of recording. Just we have to deduct the amount from the purchasing amount. So for this reason of being, purchase debit and accounts payable credit. Purchase debit, accounts payable credit. As it is purchased on credit. Am I right? Now, depreciation charge on furniture, taka 800. We know very well depreciation is an expenses, so depreciation has increased. Depreciation will be debit and accumulated depreciation, it is a liability. it will be credit. It is also a fund. Okay, depreciation expenses, furniture debit, accumulated depreciation, furniture credit. We have received 11,500 and we have to leave 500 taka. We have to leave 500 taka. This is why it is an expenses. We got cash amount 11,500, so it has come to the business, it will be debit, and we have to leave this amount. That means it is an expenses of us. This is why it is an expenses. So expenses means discount account debit first 500, and total account receivable has to set aside. That means total receivable has decreased by 12,000. Okay. It is also on 225 paper and pen. It is commonly called stationery expenses. Am I right? So if any expenses increase, that means stationery expenses increase 600 and cash has gone from the business. So cash will be credited 600. Even after that, bad debt, some amount will not come up in anyhow. This is why it will be treated as bad debts. Bad debts expenses debit, and it will gone from the account receivable. This is why account receivable credit. Bad debts debit, account receivable credit. It is never and ever be possible for you to extract. This is why it is called bad debt. Okay, on May 29, a laptop, it is an asset, am I right? It is an asset purchased by 55,000 taka. So if any assets increase or come into the business, it will be debit. That means laptop means for purpose of office maintaining. This is why we have to say office equipment 55,000 taka, and for it cash has gone from the business. One asset has come and another asset has gone from the business. So one asset debit, another assets will be credit. Office equipment debit and purchase and cash will be credit. Okay. And last items of account, some transaction. On May we have to draw 25,000 taka from bank, and it is asset. As assets has come, as cash has come from the business, so